How do you define financial independence? Is it based on one's personal assets or income? Maybe both? What is the path to becoming financially independent? And will achieving financial independence guarantee your happiness? Stay tuned because that's what we're going to be addressing in this video. Greetings, my name is Andrew May, investment advisor and certified financial planner practitioner. I've created this channel to provide you with real-world strategies designed to assist you in navigating your personal financial life. These are the same strategies that I share with clients in my investment advisory practice, as well as the same ones that I utilize in my own personal financial life where applicable. If having a more fruitful and rewarding financial life sounds appealing to you, then be sure to subscribe to the channel and the bull wanted me to tell you, also hit the bell icon. That way you'll be notified each time a new video becomes available. Why don't we define financial independence? How about having enough sources of income other than earned income from a traditional job that can sustain somebody over the course of their life? In the real world, when I'm working with a retiree or someone who is preparing for retirement, they all want to know, will they be able to generate enough income to sustain themselves over the course of their life? For retirees, we're generally considering three sources of income, which include Social Security income, possibly income from a defined benefit pension, as well as income that's generated from personal assets such as investment accounts or retirement accounts, including IRAs. For younger individuals who do not qualify for Social Security income yet because of their age and may not be receiving pension income, then to determine whether they're financially independent or not, we'll be focusing more on their personal assets and investments as well as sources of passive income. I would also like to point out that a person can technically be financially independent but still choose to have a full-time career. There are plenty of examples of this in society, such as business leaders, entrepreneurs, A-list entertainers, athletes, and yes, even some YouTube content creators. And no, I unfortunately don't fall into that last category of having achieved financial independence through having a really popular YouTube channel. As of the making of this video, I only have a handful of subscribers, but you can help change all of that by subscribing to the channel. Shameless plug. But in all seriousness, to my last point, I think it's very interesting to consider that there are plenty of people in society who have achieved financial independence but still remain actively employed or engaged in their career. Why do you think that is? Put it in the comment section below. I love to read your feedback. I personally believe that leading a purpose-driven life is the ultimate reward. Now, let's have some fun and discuss the path to financial independence, which I've divided up into 5 primary categories. Now, category 1 is when you have no savings or no emergency fund built up at all. I refer to this as being financially dependent, just the opposite of financial independence. Now, category 2 is when you have approximately 6 to 12 months worth of living expenses set aside. I refer to this as an emergency fund. It's important to have because if you lost your job or your primary source of income, these monies would help you stay afloat until you were able to find another job. Now, category 3 is when you have 1 to 5 years worth of living expenses set aside. I call this category financial flexibility because you have some real flexibility with your life now. An example from my own life that relates to this category is earlier in my career, I had an opportunity to relocate from Atlanta to New York City with the company that I was working with at the time, which was TD Waterhouse, now known as TD Ameritrade. The cost of living in Manhattan was significantly larger than the cost of living in Atlanta. It was a good thing I had built up a savings that I could use to sustain myself until I landed on my feet and got settled in my career. As an example, when I was living in Atlanta at the time, about the year 2000, I was paying $800 a month in rent for a really nice one-bedroom apartment. When I moved up to New York, I ended up paying $1,600 a month in rent for a crummy little apartment on the Upper East Side of Manhattan. To get in there, though, I had to pay first month's rent, last month's rent, a security deposit equivalent to 1 month's rent, as well as broker's fees equivalent to 1 month's rent. It cost me over $6,000 just to get into this place. So it was a good thing at that time I had financial flexibility. On to category number 4. If you have between 5 to 10 years plus worth of living expenses set aside that you can access if you need to, then you're experiencing what I refer to as financial freedom. With financial freedom, you could continue to pursue the career path that you're on as long as it made you happy and you found it rewarding. But you also have the financial flexibility to completely change your career path and pursue other opportunities that at this point in your life you found more appealing. And finally, category number 5. This is where you've accumulated enough wealth and have enough sources of income to sustain you over the remainder of your life. And this is what we call financial independence. So, by when should you have truly achieved financial independence? In my opinion, it's when you're really ready to retire, which means there are lots of people who are watching this video, younger folks who have years and decades to go before you retire. What happens is you get older, you might actually be forced into retirement due to a health-related concern, either physical or psychological, and that's really when you want to have accumulated enough wealth to sustain yourself over the remainder of your life when you may no longer be able to participate in the workforce. But alternatively, you may remain healthy and viable and continue to work until your 80s and even 90s. My hope for everyone watching this video is that you'll get to pursue a career that you find enjoyable and rewarding and do so for as long as you want. Then, when you're ready for retirement, you will have planned for it and you'll have enough sources of income to truly sustain yourself over the course of your retirement, thereby achieving financial independence when you needed it the most. So, how do you know if you've accumulated enough wealth to have achieved financial independence? In my advisory practice, I work with retirees and pre-retirees and spend time getting to know them and their personal financial situation. This takes into account their current sources of income, which might be Social Security or pension income, as well as how much money and wealth they have accumulated in their investment accounts or in real estate. Next, I'll take that information and enter it into a financial planning software program, along with other bits of information relevant to the client's personal financial life. Other bits of information will include an assumption about the client's rate of return given their asset allocation. We'll make assumptions about their estimated federal and state income taxes that they'll be paying during retirement. We'll be having to take into consideration the client's estimated living expenses, the inflation rate associated with those living expenses. Then there's the question of the cost of living adjustment associated with Social Security, and we have to make an estimation for that, as well as the client's longevity. How long are they going to live? So you see, when making projections for retirement planning, some of the information we'll have is hard data, and then other are assumptions. Well, you might be thinking, at this point, we're done. We've taken all the relevant financial information, entered it into the financial planning software, run the projection, and now we can see whether the client will have enough money to last for the remainder of their life. At this point, I'll even take it a step further and run a couple of what I call what-if scenarios, making some of the assumptions that we made previously even more conservative. This might include decreasing the rate of return that we expect on the client's portfolio or increasing the inflation rate. I find that running these what-if scenarios for clients can be very helpful for discussion purposes because it helps to demonstrate how sensitive a client's retirement plans can be just to small incremental changes in some of the assumptions that we've made. Next, to help the client through their many years of retirement, it's a good idea to update this projection each and every year when you meet so that you can review it with fresh numbers and again, revisiting the assumptions to make sure they're sensible and we believe them to be as accurate as possible. The financial projection will continue to help to serve as a guide during the client's retirement years to help make sure that we're still on track. And if for some reason we're not, due to any sort of unexpected occurrence, then we have the ability to make changes where possible. While there are other financial planning concepts that do exist that can be helpful in allowing people to determine whether they're prepared for retirement or not, such as the popular 4% rule, I would use this more as a rule of thumb, and I'd prefer to look at each individual's personal financial situation in great detail and create a plan around that to help determine whether they are prepared for retirement. If you're someone who's preparing for retirement and would like to find out whether you're on track to becoming financially independent so that you can enjoy the retirement you've been planning for so many years, then my recommendation would be to consider consulting with a certified financial planner professional. So in summary, please remember that first, financial independence is a function of one's income as well as assets. The assets are going to be used to generate income, and the income that you might be receiving during retirement could be coming from Social Security or a pension, but then other than that, it's primarily going to come from the assets which you've accumulated or passive income that you're getting from other sources. The next takeaway is that if you refer back to category number 1 earlier in the video, if you're somebody that doesn't have any savings whatsoever and you're fully financially dependent upon your job, then I would recommend doing whatever is necessary to be able to save somewhere between 6 to 12 months worth of living expenses so you can have that set aside in an emergency fund, so in worst case scenario you lose your job or your primary source of income, you can stay afloat during the period of time it's going to take for you to find another job. The third takeaway is that if you're somebody who's preparing for retirement, then I suggest enlisting the assistance of a certified financial planner professional. Remember, you don't have to go it alone. And finally, unless you truly are ready to retire, it's important to recognize that there is more to life than simply achieving financial independence. There's a reason that so many successful people in society have chosen to continue to pursue their career even after they've achieved financial independence. Why do you think that is? Put it in the comment section below. If you found this video helpful and feel as if it could have a positive impact on your financial life, then be sure to hit the like button and subscribe to the channel. Also, if you know of anybody else who may benefit from the information contained in this video, please feel free to share the video with them. Until next time, I'm Andrew May, investment advisor and certified financial planner professional, and I believe that you can do this.